He had 30 million followers. He sold courses on how to build wealth. He stood in front of Lamborghinis and told the world that the difference between rich and poor was just knowledge. And then on September 25th, 2025, the Securities and Exchange Commission filed a 31-page complaint accusing Tai Lopez of running a $112 million fraud. Not a bad investment, not a failed business, a Ponzi scheme, the kind where new investor money pays old investors. Not because the business is working, but because the business was never real. Today, ValtR opens a ledger on Retail Ecommerce Ventures. The company Lopez built on the bones of RadioShack, Pier 1, and Dress Barn. We follow the money. We expose the architecture. And we show you exactly how $112 million moved through a system designed to look like success from the outside. This is the forensic audit of the Tai Lopez empire. The vault is open. Who is Tai Lopez? To understand this fraud, you need to understand the man at the center of it. Because Tai Lopez did not become famous by accident. He built one of the most calculated personal brands in the history of YouTube. And that brand is exactly what made the fraud possible. In 2015, a video appeared online. A man standing in his garage, next to a Lamborghini, holding a book. He looked directly into the camera and said, "I don't want to talk about the Lamborghini. I want to talk about knowledge." That video became one of the most watched ads in YouTube history. Hundreds of millions of views. A cultural moment. His message was simple. The world is divided into people who understand how money works and people who don't. Buy his course. Read more books. Join the 1%. And for years, Lopez sold that message. Courses, seminars, masterclasses. He built an audience of people who genuinely wanted to build wealth and saw him as proof that it was possible. Then in 2020, he announced something bigger. He had partnered with a tech entrepreneur named Mehr, co-founder of the dating app Zeus, and together they were launching Retail Ecommerce Ventures, REV for short. The pitch was elegant. COVID had just destroyed brick-and-mortar retail. Iconic American brands, RadioShack, Pier 1 Imports, Dress Barn, Linens and Things, Model Sporting Goods, were going bankrupt one by one. REV will buy those brand names for pennies, strip out the physical stores, and relaunch them as e-commerce businesses. Pure digital. Low overhead. The nostalgia of the brand plus the efficiency of online retail. They called it the future of shopping. And to fund it, they needed investors. So Lopez did what he always did. He went to his audience. He promoted REV. He made videos. He appeared on podcasts. He told anyone who would listen that REV's brands were on fire. Those are his words from the SEC complaint. And that cash flow was strong. Hundreds of investors said yes. Between April 2020 and November 2022, REV raised $112 million. The problem, and this is where the forensic audit begins, is that almost nothing Lopez told those investors was true. Here is how the fraud actually worked, step by step, because this is not just a story about one man. This is a blueprint. The exact mechanics used to extract money from investors while keeping them completely in the dark. Step 1. The promise. REV offered investors two types of investments. The first was unsecured notes, essentially IOUs, promising annualized returns of up to 25%. The second was equity, ownership shares, with monthly dividends as high as 2% per month. That is 24% per year. In writing. Signed. Now, pause on that number. 25% annual returns. The S&P 500 averages around 10% over time. Warren Buffett has averaged around 20% annually across his entire career and is considered the greatest investor alive. Lopez and Mehr were promising to beat him consistently through a portfolio of bankrupt retail brands they had owned for less than a year. That alone should have been a red flag, but we will come back to red flags. Step 2, the segregation lie. Lopez and Mehr told every investor that their money would go directly into the specific brand they invested in. You put money into Pier 1. That money goes to Pier 1. It would not be mixed. It would not be moved. The SEC's complaint says this was a lie from the beginning. In reality, REV was treating all investor funds as one giant pool. Money raised for RadioShack was flowing into Dress Barn. Money raised for Linens and Things was covering Pier 1's operating losses. The walls between the brands did not exist. Step 3, the books. This is where the forensic ledger gets damning. Internal financial statements, the real ones, not the ones shown to investors, tell a completely different story from what Lopez was saying publicly. Dress Barn lost $13.7 million in 2020 and another $10.7 million in 2021. Steinmart posted net losses of $1.7 million and then $5.7 million over the same period. The brands were not on fire. They were burning through cash. But here is what Lopez told investors in February 2022, the same month those internal statements existed. He told his team that Dress Barn was performing well. The company had just lost nearly $11 million a year before. The SEC's complaint makes clear he knew. Step 4, the Ponzi mechanics. When investors started asking for their returns, the promised 25%, REV had a problem. The businesses were not generating enough revenue to pay them. So Lopez and Mehr did what every Ponzi operator does. They used new investor money to pay old investors. According to the SEC, at least $5.9 million in investor returns were funded this way, not from profits, from other people's capital. Think about what this means structurally. Every payment that went out to a satisfied investor, every person who told their friends, I got my returns, REV is legitimate. That payment was funded by someone who had just put new money in. The satisfied investor became the advertisement. The advertisement brought in more victims. The cycle continued until it mathematically could not. Step 5, the personal extraction. While all this was happening, while the brands were losing tens of millions, while new investors were unknowingly paying old investors, Lopez and Mehr were moving money out. The SEC alleges they misappropriated approximately $16.1 million in investor funds for their own personal use. $16 million taken from investors who believed they were building their future, while the man who sold them the dream of financial freedom was funding his own lifestyle with their capital. And there is one more detail the SEC's complaint highlights. REV's chief operating officer was Mehr Birkenrode, Lopez's cousin. She was presented to investors as someone with over 10 years of experience managing multi-million-dollar companies. The reality, according to complaint, before joining REV, Birkenrode had worked as a substitute preschool teacher, a radio station promoter, and an assistant to Lopez at a previous venture. The credibility she was supposed to give the operation, it was another fiction. Collapse. Ponzi schemes do not collapse because someone gets caught. They collapse because the math runs out. At some point, the money coming in from new investors is no longer enough to cover the payments going out to old ones. And when that point arrives, everything stops at once. REV, that point came in 2022. Investors who have been receiving their payments on time started getting silence instead. Missed interest payments, unanswered emails, excuses about liquidity. The investor community, many of them connected through online groups, began comparing notes. By 2023, creditors had foreclosed on REV's assets. A group called Omni Retail took control of the brands. Lopez and Mehr were out. The brands they had promised to resurrect, RadioShack, Pier 1, Dress Barn, had new owners. The investors were left with claims against a company that no longer existed in any meaningful form. Then on September 25th, 2025, 3 years after the collapse began, the SEC filed its complaint in the Southern District of Florida. 31 pages. Tino Lopez, Alexander Mehr, Mehr Birkenrode, charged with securities fraud under Section 17A of the Securities Act and Section 10B of the Exchange Act. The SEC is seeking permanent injunctions, civil penalties, disgorgement of the money they allegedly took, and permanent bans on Lopez and Mehr ever serving as corporate officers or directors again. This is a civil case, not criminal charges. That distinction matters. Civil fraud requires a lower burden of proof than criminal fraud. And as of this investigation, Lopez and Mehr have not issued any detailed public rebuttal to the SEC's specific allegations. What makes this case significant beyond Lopez himself is the mechanism. Rev raised $112 million from hundreds of ordinary investors, not institutional money, not hedge funds. People who watched his videos, trusted his brand, and wrote checks believing they were investing in the future of American retail. The influencer was the instrument. The audience was the asset class. That is the architecture of this fraud, not a complex financial instrument, not a sophisticated offshore structure, just a man with an audience and the willingness to use that audience as a funding mechanism. The lesson: 3 red flags. Every forensic investigation ends with the same question, not just what happened, but what do you do with it? Because the Tai Lopez case is not unique. The SEC prosecutes influencer-backed fraud cases every single year. The names change, the brands change, the mechanics do not. So here are the 3 red flags from this case that apply to every investment opportunity you will ever be offered. Red flag 1. Returns that outperform a market by design. Rev was promising 25% annually. When someone offers you guaranteed returns that beat professional investors, ask one question before anything else. Where exactly is this return coming from? What asset, what revenue, what mechanism generates this number consistently? If the answer is vague, if you get a story instead of a structure, that is your signal. Legitimate investments explain their return mechanism clearly. Fraudulent ones replace that explanation with enthusiasm. Red flag 2. The promoter is also the investment manager. Tai Lopez's value in this scheme was his audience. He had 30 million people who trusted him. That trust became the fundraising infrastructure. When the person encouraging you to invest is the same person who benefits from you investing, that is a structural conflict. It does not mean the investment is fraud. It means the person promoting it has an incentive to oversell it. Get independent verification. Look for audited financials from a third party, not documents produced by the same people asking for your money. Red flag 3. Your money is not ring-fenced. Rev investors were told their capital would stay within their specific brand. It did not. This is one of the oldest tricks in investment fraud. The promise of segregation. Before you invest in anything, especially a multi-entity structure, ask specifically and in writing, can your money be transferred to other parts of the operation? If yes, under what conditions? Who controls that decision? If the answer is unclear or the agreement does not reflect what you were told verbally, do not invest. Tai Lopez built a career telling people that the difference between success and failure was knowledge. He was right about that. He just omitted the part where he planned to profit from the gap between what he knew and what his investors did not. The SEC case is ongoing. The full financial picture of REV is still being untangled in court. If you or someone you know invested in any REV brand, Pier 1, RadioShack, Dress Barn, Linens and Things, Model Steinmart, or any of the others, the SEC's investor complaint line is in the description below. Every financial crime leaves a trail. Today we followed it. If this investigation gave you a clearer picture of how influencer fraud works, subscribe to ValtR, because the next case we are opening is one where the numbers were even bigger, the lies were even cleaner, and somehow no one went to jail. The vault stays open.